Hello, good morning, good afternoon, depending on where you find yourselves. Um, my name is Robert Schwant. I'm the Senior Vice President of Sales and Strategic Partnerships here with Stock and Option Solutions by All Shares. I'd like to welcome everybody to another webinar that we're hosting. I'm excited to talk about different compensation trends within equity compensation in public companies today. I'm joined by a colleague of mine that I'll introduce here in a moment. However, that said, I would like to talk a little bit about where this name All Shares is coming from. Stock and Option Solutions, affectionately known as SOS, has been doing this now for over 25 years in the equity compensation space. And earlier this year in January, we were acquired by a European company called All Shares. And we're very excited about this acquisition because of multiple reasons, but historically, SOS has always been a company that has played in the administration, professional services space within equity compensation. However, a couple of years ago, we started seeing a trend, and that trend was a consolidation in the marketplace of service providers or vendors so that they could provide really an end-to-end solution within equity compensation. And that's really a reaction to the marketplace because the marketplace too was looking for that. You know, when it comes to equity compensation, you've got everybody from accounting to finance to legal to payroll to HR, everybody's involved. And oftentimes that comes with a plethora of different service providers. So with this acquisition, we're now able to come in and provide that end-to-end solution within the intelligence, the data, the strategy, much of what we're going to be talking about today. We're also able to do the plan design and the build. Of course, the admin, we've been doing that, for 27 years now. But then lastly, also the governance. And, so we're excited to be an all shares company now. Before the year is out, we will complete the rebranding and just be that all shares company, but it's still the same SOS people and what we've been doing. With that, I would like to introduce a colleague of mine, Albert Larson. He is the head of data and intelligence when it comes to or at All Shares, and he's going to be leading us through this presentation today. So with that, Albert, I will pass it off to you.
Perfect. Thank you, Robert. And firstly, just want to begin by thanking everybody for logging into this webinar today. As Robert mentioned, my name is Albert Larson. I've been working with executive compensation in both private and public companies for the last 10 years. And today I am head of data and intelligence here at All Shares. And what we do in data and intelligence is one of our business lines, where we help or empower companies to make informed and data-driven decision when it comes to their incentive programs and when it comes to their compensation structures. And we do this partly by leveraging our extensive database with our expert advisory, of course, but also through our cutting edge technology. And one of the questions that my team and I get asked quite a bit, of course, is around executive talent retention and how companies are structuring their compensation or executive compensation packages and how and just guiding our clients through that with our data, with our expertise, especially now that it's becoming more complex, but also importantly, that it's becoming such an integral part of companies' corporate strategies. And so today, what we've been doing is, or what we've done is collecting the data for companies on the S&P 500. And that's what we'll be doing today, unpacking that data, looking at how these total compensation packages are structured, looking at how boards are thinking a little bit about their different performance metrics, the executive recruitment and retention, but also the conversations that are going on in the boardrooms and what this all means in the grand scheme of things when it comes to compensation structuring. And so before we get into it, just a little bit about the data. What we've been looking at here is, of course, all the S&P 500 companies as of June 2026. We've been collecting this data from publicly available sources. So the latest available proxy statements and similar. And I just want to mention once again before we get into it that all of these materials will also be shared with the participants after the seminar. So with that said, I'm going to share my screen here and start by looking at some of the data for the Chief Executive Officer role. And what's really interesting this year is when we're looking at the increase in total compensation, we saw that it increased by about 5.6% to around 1.3 million, or I mean, sorry, 16.5 million US dollars. And why that's interesting is because that increase in the total compensation shows somewhat of a return to normalization since the pandemic, since the COVID-19 pandemic. We've had quite a few years of volatility when it comes to how these packages are structured, the increases in these packages. And this is the first time we're seeing sort of that return to normalization at 5.6%, which is more aligned with the historical averages. An example is, for example, last year we saw that the total compensation increased 10% across the board. So, like I mentioned, somewhat return to normalization here. And what's interesting when we're looking at this data is, of course, it shows the heavy reliance that these companies have when it comes to creating skin in the game for their executives. And we see that partly by looking at the fixed pay, which we saw was about 3 to 8% of the total compensation, which is a decrease from last year. And we're seeing when you look at the entire variable structure, the performance-driven variable pay, what we refer to as the STI or the short-term incentive, which is effectively the annual bonus, the cash-based bonuses, and the LTI, it makes up approximately 80% or 85 to 93% of the total compensation packages. So we see a heavy reliance on these performance-based programs. And like I mentioned, the long-term incentive still continues to be the primary driver, making up about 76% of these compensation packages. And so the key takeaway sort of when we're looking at the CEO role for this year is one, somewhat of a return to normalization when you're looking at the overall increases. We're seeing, like I mentioned, less fixed pay, more variable, more focus on that. And part of the reason we're seeing more of a focus on the long-term incentive is, of course, partly intense scrutiny coming from the Say on Pay directives and so on. But also we have gone through a period of macroeconomic volatility, some geopolitical uncertainty. So some companies really want to protect their margins, but also want to show the shareholders, of course, that all of the compensation is being somewhat tied to performance.
Hey, Albert, you mentioned here that up to 93% of the total compensation could be variable.
No.
In today's market conditions, the volatility, how are the boards reacting to this? When considering, the risk, the volatility, can you speak to a little bit to that?
Absolutely. And that's a very relevant and great question, of course, because when you have 80 to 85 to 93% of your total compensation in equity, and which is variable, when you have market dips that are caused by macroeconomic volatility or geopolitical uncertainty, things that are generally outside of the executive's control, those kind of golden handcuffs that they have somewhat lose their shine. So what we've been seeing with a lot of the boards is a focus on making these incentive plans a little more sophisticated, where you might have multiple plans. We're seeing more companies implementing long-term vesting periods when it comes to their restricted stock. But we're also seeing PSUs in companies where there's more of a focus on relative TSR. We see that that's increased quite significantly this year, with approximately, I believe the number was about 70% of the companies in the S&P 500 are now using relative TSR as a metric when measuring the long-term performance in the share price.
All right, thank you.
And also we also break down the data through a sector perspective. And what we see is that when you're looking through this lens, there is a lot of divergence. We see tech continues to dominate these market premiums, followed by financials. And what we see here, tying it back to some of the trends that we saw in the broader the chief executive role, is that you see that tech is really also pushing these equity boundaries, and that they approximately have 81% in long-term incentive for their chief executives. And we also see a lot of companies, particularly in the tech sector, implementing big one-time, one-off annual grants, mega grants. You saw Broadcom do it, AMD, and so on, that are a little more aggressive one time, but also, of course, very performance contingent and reliant on market capitalization or these companies reaching a specific revenue milestone and similar. And then when you're looking at the remaining sectors, it is a little more conservative when it comes to the variable portion, but they arguably, of course, make up for that by allocating a more significant amount to the fixed pay and the short-term cash-based programs, making them a little more predictable, of course, and fixed. And so what we see here is tying it back to data and intelligence. And what we do here at All Shares is that there isn't really a one-size-fits-all analysis or data when it comes to these sectors. It's really which sector the company operates in that dictates the peer group, the companies to use, really diving down into the relevant talent market to say. And then, of course, in tech, we're of course seeing these high stakes target when it comes to the equity plans, typically PSUs that are tied to these very ambitious market cap goals and these ambitious revenue milestones.
It's interesting. Well, number one, you can't get through any type of webinar without bringing up AI. And so no matter what sector you're in, the AI conversation is definitely part of your business. And I was curious to see if you're seeing a lot of like cross-sector poaching when it comes to that AI talent, and some of these companies have different LTI plans than the technology companies. How are they competing in the marketplace?
Yeah, great question. And I mean, cross-sector poaching is absolutely something we're seeing. We actually did a similar analysis to this in Europe a while back. And what we saw when we were looking at the executive churn was that one of the roles that had churned the most in 2025 was the CTO and the CPO role. About 25% of the companies we looked at had changed that role, and they weren't necessarily going to tech companies. They were going to industrial companies and energy companies and so on. So it really shows that you're having this kind of cross-sector poaching where companies are really focused on implementing artificial intelligence and getting that into their companies. And to your point, when you're attracting talent from certain fast-growing tech companies and similar, you yourself might be an industrial company or an energy company, maybe from a little more conservative background. You can't necessarily copy the Silicon Valley playbook and offer 80% equity mix to your executives. It might not fit your capital structure, it might not fit your shareholder expectations, and so on. So what we're seeing a lot of companies focusing on is, of course, the communication of what they're able to offer, especially if, once again, back to the industrials example, you might have higher fixed pay, you might have more predictable short-term bonuses and similar, of course, including your equity mix as well. But the ability for the client to communicate that in a clear and effective way is extremely important, and a way to maybe attract certain tech executives that might be fatigued by volatility in the market and so on.
Yeah, yeah.
Perfect. And then we also look at the chief financial officer here and just the broader executive or senior executives when it comes to the C-suite. And what we see is very precise internal equity metrics when we're looking at just the broader executive team. So for the CFO, we see that the average base pay the average base pay was 731,000 US dollars. And when we were looking at broader executives and the rest of the management team, we saw that the average base pay there was around $782. So when calculating that relative to the CEO, we see that it's approximately 0.6x for both CFOs and just the rest of the management team. And then when we're looking at the broader compensation, the total compensation, all of these, the base pay, the pension, the short-term incentive, the benefits, everything included, we saw that the total comp dropped to slightly lower. So about 0.4x for CFOs and 0.36x for other executives. So primarily driven by the risk profile that we see CEOs having slightly higher equity grants, of course, compared to the rest of the management team. What's also interesting, which we touched upon a little with the CTOs, but what's interesting from the S&P 500 this year as well is that we're seeing it's the highest CFO churn in S&P 500 history. So we've never had this many CFOs change roles when it comes to these 500 companies. And it's partly driven by fairly high CEO turnover. You have CEO turnover that's above the historical averages as well, which obviously has a kind of a ripple effect when it comes to the CFO role. But we also see, also tying it back to the normalization, that we've had years of macroeconomic volatility, geopolitical uncertainty, and a lot of these big S&P 500 companies are, of course, looking for seasoned executives when it comes to these types of roles, and that have a track record of doing this. So it's not anything we see in the data this year necessarily. We see that the CFO role increased and the total compensation packages were fairly aligned with what we saw last year, but we are expecting that next year when these compensation disclosures are released and similar, that we will see a little more movement and maybe slightly higher compensation when it comes to the CFO role.
Yeah, I found it interesting that from a ratio standpoint, there isn't a lot of discrepancy between, like when you look at the compensation distribution, the base pay to the variable components of the pay is very similar when you look at the CEO versus the CFO. The CEO was up to 93% while the CFO was up to 91%. Relatively speaking, not a huge difference there.
No, exactly. And we also look at the short-term incentive, so the annual bonus and cash programs here. And what we see here, what we've seen for many years is, of course, that the financial metrics can continue to dominate when you're measuring the outcome of these programs, both for the CEO and the broader executive management team. It is primarily EBITDA or different variations of EBITDA and the operational results that remains the most common metric. So we saw about 55% of CEOs had that and 52% of broader executives. And what we see in the data is also that the weight of those EBITDA targets and those financial metrics is very high. So it usually constitutes about 43% of the outcome of the short-term or the annual bonus program for chief executives, and I believe it was 42% for the executive management team. And that's closely followed by revenue metrics and free cash flow metrics, as you guys can see by the graph. An interesting trend this year when we're looking at the broader S&P 500 is that we see most companies including more metrics when it comes to their short-term plans. So we're seeing an increase in the metric count, and the average was 5 metrics when it came to these programs. And one of the reasons for this is, of course, companies are implementing more operational metrics into the plan. We're seeing a lot of companies have also implemented metrics tied to artificial intelligence adoption and using AI for operational efficiency. But we also see that the prevailing research, and one of the reasons companies are doing this is, of course, that there's a strong correlation between the use of more metrics. So if you're using 5 or more metrics and the payout of the program. So across the boards, we're seeing higher or the count of metrics increasing. Another trend is also we're seeing a very minimal or a lower integration and impact when it comes to ESG metrics. And so only a small fraction of the companies that we have include or that are in the S&P 500 have applied these metrics this year, and the weight of the metrics on average is about 8 to 9%. So hardly very significant or meaningful when it comes to the broader payout of the short-term incentive plans. And we see also that when companies are including these ESG metrics, it is primarily geared towards the governance aspect of it. So we see KPIs like succession planning, talent retention, and also companies very fixated on making these metrics, when it is particularly ESG, quantifiable, making them objective, making them defendable when talking about the payouts. Yes. And then we have the long-term incentive programs here as well. And here we see, if it was very much about financial metrics and similar operational metrics for the short term, it is really alignment or shareholder alignment and retention when it comes to these equity-based programs. And despite pressure from investors on performance contingent plans, we are seeing that time-vested stock options and similar are the most prevalent structure. We see that it's used by 44% of companies for the CEO and 43% for other executives. Structurally, we also see that the market has standardized at around a 3-year vesting period, and bringing in the more broader 2026 market perspective, while the 3-year cliff or graded vest remains the baseline, recruitment trends show that boards are increasingly using specialized sign-on equity structures to protect incoming talent from market volatility. And furthermore, we're also seeing sort of stricter compliance vetting around regulatory frameworks like the Section 409A, clawback provisions, meaning that these equity programs are being audited with a little more rigor to protect against corporate risk here.
It's interesting, Albert, as what we're seeing in the marketplace, as these plans become more and more complex, companies need a higher level of sophistication to administer these plans. Depending on how large your company is, you may have 1, 2, if you're lucky, stock plan administrators working in the environment to be able to handle a lot of this. And if just like the CEOs and CFOs moving around, stock plan administrators traditionally can move around as well. And if you lose one or both of your people, it really puts these companies, in a bind. So, what we're seeing is, a lot of that movement, but with more complexity, companies just need to make sure that they've got a plan in place to administer these plans on an ongoing basis.
Absolutely. And finally, we also include, which is often an overlooked aspect when it comes to the total compensation, but the benefits. And what we see when it comes to the executive benefits is the average total benefit value was $253,000 for these roles. But we also see that it scales very dramatically based on the size of company that we're looking at. So execs in the large cap segment of the S&P 500 at about 4 times as high executive benefit packages as what we defined as the small cap here. And if we're looking at the trends here, the one trend that really sticks out and the one benefit that really sticks out is the one that comes to or personal security, which we saw increase quite significantly. I believe it was also around 4x this year. So yeah, one of the benefits that really stuck out this year. And what we see is that, like I mentioned, it's fairly standardized. It's often overlooked by companies, but of course, in a period where you have these exuberant total compensation packages that we've somewhat been touching on, and when you have these mega grants and similar of the equity, executive benefits is sometimes overlooked, of course, but it is a very integral part and something that's very efficient and cost effective in order to retain talent. So some interesting trends when it comes to the executive benefits.
Yeah, I was surprised, not surprised, but I just found it very interesting that the personal security number is as high as it is. It's a
Yeah,
significant amount.
absolutely. And so just to sort of wrap up and cover the findings here, I mean, we see a highly competitive talent market out there. And like we mentioned, when you're looking at the sector perspective, that really getting the most use out of this type of benchmarking data is by doing very, micro benchmarking, customized analyses, and similar. Uh, like we saw with the LTI trends, the weight, and what you also mentioned, Robert, the weight of this is increasing and becoming an even more integral part, of course, of the executive compensation practices. So it's really important to optimize this, effectively communicate it, make it a part of the broader scheme. And with a focus on AI, of course, cross-sector poaching is becoming more prevalent. So creating attractive compensation offers and spending some time on really making sure that they're effectively communicated is definitely something that we strongly recommend.
Well, thank you, Albert. Some great information. I know it's a lot of work compiling all this information and putting it in a format that can be shared with others. So I want to thank you for that. I'd also like to thank everybody for attending today. We get to do this again next week, same time, same place, except we're going to cover that on the private side of the market. So it'll be interesting to see, kind of some of the differences when it comes to the trends from the public to the private side. We'll also be sure to get this presentation into your hands so you'll have the slide deck for your own review. That said, looks like we're right at time, and so we'll adjourn here, and we'll see you next week.
Thank you, Robert. Thanks, everyone.
Thanks, Albert.